You know, Richard, I've seen that several times, and it just occurred to me today that you very skillfully left off both journalists and media relations professionals from the list from the skill categories.
They're much more skilled than ever before.
Much more skilled, yes. There's an entirely separate category.
It's self-evident.
Yes. For those of you I haven't met, my name is Jonathan Freed. I'm a media relations officer here at the Fed. Welcome again. We have about 45 minutes for questions, and just the usual friendly reminder that the loving topic of monetary policy is a no-go for questions today. We'd really like to keep the focus on what everybody is here to talk about today. Okay, who's got a question? What's to go? Hang on. Whoops. I gave you the first one last time. I'm going to go to John this time. Mr. Spicer.
Hi. John Spicer with Reuters. Just maybe a forecast update. You talked about growth. You expect gradual growth over the next few years. I was trying to look back at your last forecast. Do you still have a forecast for 2.75% growth this year? And could you talk a little bit about this year's growth expectations?
Yeah, we're looking for something around, pretty close to the consensus. The blue chip consensus over the next 4 quarters is 2.4. We're looking for something, a touch firmer than that, but, not so much that I would say it's a meaningful difference. Very moderate growth, much weaker than what we would actually desire.
You have a follow-up, Sean?
On the jobs side of things, this forgive me, it sort of dips into policy slightly, but we do have a number coming up on Friday. I think the consensus is for 140K new jobs growth, and we talked a lot about jobs here today. I mean, at which point does the Fed need to sort of step in to help this? I mean, can you talk about what you expect maybe Friday and when it might push the Fed into action, perhaps?
I'm out of the business of forecasting payroll employment growth. I don't expect to get back into it anytime soon. I think one thing that's complicated the interpretation of the employment statistics is the unusual winter weather we had this winter, where January, February, and March were unusually mild. And if you remember, early in the winter, we had pretty strong employment gains, and then as we got into the spring, employment growth faltered a bit. So the question is that just payback for the earlier strength that was weather-driven, or is it the start of something, a more sizable slowdown? And I think that's sort of the question on the table. And I'd be surprised if we could answer that question with 1 month of data. I think it's actually going to take several months to get a real good sense of how important the weather effects were in terms of affecting payroll employment. If you look at the trend over 6 months, 6 months trend is definitely stronger than it was before. So I still think that the underlying pattern of employment growth is that we're seeing a gradual strengthening. Not as strong as we like, but I think the trend is still looks upward until that's sort of contradicted by future data. If it is contradicted.
Caroline.
Also a forecasting question, but you do forecast the unemployment rate. So I was wondering if you could update us on where you thought that would be at year end. And also, I was wondering what the explanation was for the divergence between New York City and the national rate, if that was Wall Street layoffs or what's going on there, and if you expect that trend to continue.
Well, let me take the second. We actually talked about that yesterday, because if you look at the slides, there's a little bit of a conundrum in the sense that if you look at the employment growth in New York City, it's actually been quite strong relative to the region and relative to nationally. But then if you look at the unemployment rate, it looks quite a bit weaker, both absolutely and relative to the national average. And so the question is, which one is right? I think the general view, I think among economists broadly, and I'll let these guys speak for themselves, is that the payroll employment numbers tend to be a little bit more reliable statistically, especially on sort of very short time periods. So I think we probably put more weight on the upturn in New York City employment than we would on the weakness in the actual unemployment rate. In terms of the forecast, we're anticipating that we'll pretty much along the lines of the consensus on the Federal Labor Market Committee, a very gradual decline in the unemployment rate, stretching out over the next few years. But I think when you look at our point estimates, I think it's also important to really recognize that there's quite a bit of uncertainty around those point estimates, and so we don't. lots of outcomes are certainly within what we would see as the feasible set. And as I mentioned in my remarks, so we have two significant downside risks to the economic outlook, both what happens potentially in Europe and also what happens in terms of how we resolve the fiscal cliff that's coming at the beginning of 2013 here in the United States.
Anybody else here want to take that, or we good?
You want to take the other side?
Well, I'll say that the rising unemployment rate in New York City was surprising, given the job growth rates. We've looked. It remains a puzzle. I mean, we've looked at a number of the factors that you normally look to, mainly rising labor force participation. The strength of employment growth, attracting more workers in, commuters. And also dual job holders. And again, we haven't seen enough there that really helps us explain the rising unemployment. I will mention that the payroll job numbers come from a survey of business firms, and the unemployment rate is computed from a survey of households. So they're different universes, and they're giving mixed signals right now. And again, the usual suspects sort of don't point to an obvious reason.
Okay. Steve, before I get to you, I just want to let Charles, I can see you back there, just so you'll know, but Stan next to you I can't see. Kevin, if Stan is waving, can you just let me know, ever? I just don't want to freeze you out of asking just because I can't see you behind the pillar. Steve.
Yeah, up until now, the situation in Europe has given us some adverse effects, such as decline in stock prices and appreciation of the dollar, but also some positive effects, such as helping you keep long-term interest rates down. I'm assuming that the net effect is negative, but how negative?
I think it's hard to disentangle all the effects of Europe because we don't know what the counterfactual would be. What would happen if Europe was on a more settled course? I think you've identified the relevant factors. Clearly, one negative, of course, is the fact that the European growth has stagnated, and therefore that reduces the demand for U.S. Goods and services exports. We don't export such a large share of our production to Europe, though, that you would think that's a pretty mild effect. I think on the other side, as you said, presumably the events in Europe are presumably one factor behind the low level of long-term interest rates in the U.S., which obviously provides support to the equity market and to the housing sector to some degree. I also think another important effect is the consequences on global commodity prices. One thing that you've seen, quite sharply over the last 3 to 6 months has been a pretty significant decline in a broad-based array of commodity prices. Now, some of that's Europe, some of that's slowdown in China, but obviously that has some potential benefits to the U.S. in terms of supporting real disposable income. It looks like gasoline prices, seasonally adjusted basis, will come off pretty sharply. They normally rise this time of year. They're actually declining this time of year. So you seasonally adjust that, you're going to see a pretty significant decline in gasoline prices, and that will that'll hold down inflation, support real income, and that's something that's actually going to be a positive in the outlook that makes it more likely that the U.S. economy will be able to continue to grow.
Hang on a sec, Mike. I just want to remind everybody who's joining us on the web that you can submit questions. We do have a few. I'm just going to take one of those before I go to you, Mike. This is from Brian Nearing at the Albany Times-Union, asking, what is keeping lower middle wages in upstate New York from stagnating as much as elsewhere in the region and the U.S.?
Well, it's actually the low skill jobs that are seeing their wages actually increase a little bit more than nationally. So part of that may be that wages have been depressed a little bit more, say in other parts of the country, but it's not quite clear exactly what's been driving that low wage growth. Some of it may be that people from the middle have actually been driven into these lower paying jobs, and they actually end up being a little bit more productive, so they're able to command higher wages.
The other thing I'll just add to that is this is all a relative thing. So when you look at other parts of the region, in particular the New York City area, where at that lower scale end of the spectrum there's more immigration, which actually increases the supply for that particular group, which depresses wages a bit. So it's a relative thing. There's not as much of that activity in upstate and in Albany, So that force that would put a downward pressure on wages isn't there.
Okay. And Brian, if you want to ask a follow-up, listening out there in Cyberland, you can submit it, and I will try to get it in for you.
Hi, Lauren Weber from the Wall Street Journal. I cover careers and workplace issues, and on the polarization issue, I speak to job seekers all the time who are doing all the right things. They're going back to school, they're getting nursing degrees, they're getting certifications in software languages. They're still not finding jobs. And a lot of times it's because they're being told you don't have the experience. Right. So it's a conundrum. And you've made some recommendations for both job seekers and also for educational policy, but where do the employers fit in terms of being perhaps a little more flexible on that kind of an issue?
Yeah, so I mean, part of this I think is that at any point in the business cycle, people that are recent graduates, despite whatever programs they're in, tend to have higher unemployment than say more established workers. So that's documented. So it's not unusual to hear these stories even during better economic times. But I think if there's certainly been an increase in say internships and other programs that employers have been offering, maybe to people that are getting traditional bachelor's degrees, and I think that's helped some people get experience. But that doesn't necessarily mean that everybody's been able to take advantage of those programs. I think especially because this is still somewhat of a recent phenomenon in terms of employers trying to get workers more sort of training before they take their jobs. But I think what this is also pointing out is that even within different occupations, even people who are, say, being trained for technically oriented careers, those with more experience are able to sort of have an easier time getting a job than those who haven't. So it may be that employers need to get, again, more integrated into the process for these people as they're getting their degrees so that they can provide more opportunities to give them more experience, whether it's for jobs that they may eventually take with those particular employers or just sort of more general, more collaboration between employers and training institutions.
I'll just add, it's part of it, of course, there's a big cyclical aspect to that. Right now, unemployment is still very high, and if you're a company and you can choose between a lot of experienced workers and a lot of new graduates, you're more likely to opt for the experienced worker. Once a lot of those people are reemployed, then it'll probably get much easier for the newly educated people. So it's the recommendations are kind of longer career lifetime sort of decisions, I think.
Anybody else? I have one from Paul Wiseman at the AP asking, did job polarization increase during and after the recession or continue the previous trend?
So what tends to happen is that during recessions, when we look at these low skill the low middle skill jobs that are lost, they tend to be lost disproportionately during recessions. So almost all of that loss occurs during the business cycle, and then what happens is those jobs don't come back. So polarization, in some sense, can be thought of as a cyclical trend, although it's been occurring over business cycles over the past 3 decades.
Yeah, we've noticed in many discussions with smaller businesses that when the recession began, people started to introduce new technologies to save on labor, and they've actually found that the productivity enhancement was actually larger than they were actually anticipating. That it was actually more feasible to continue to expand in that direction. So, the experiences of introducing these labor-saving technologies actually turned out to have a more sustained, footprint to it than I think what people expected. Now we seem to be on the other side of that a little bit, in the sense that where productivity growth was really, really high during the recession, now we're in a period where people are actually finding that, well, they actually do need more workers, and so they're hiring more workers. So job growth has actually been somewhat firm relative to the actual increases in output, and productivity growth has suffered as a consequence.
And just one last thing. Also, during business cycles, the jobs that are lost are almost exclusively in these routine type oriented jobs. Job growth at the high skill end and the low skill end actually tend to be relatively stable, and even to some extent have increased during recessions.
Is there a hand waving at the back? Yeah, Charles.
Has it become easier or harder for workers to sort of skill up and move from a low skill job to a low to middle and middle?
Yeah, that's not an easy question to answer. Sort of how this has progressed over time. The severity of sort of this polarization It's certainly clear that around recessions that things get more difficult. That's when a lot of this sort of adjustment seems to take place. But beyond that, I think we're just trying to make suggestions as to how to make things better across the board. It's certainly been a trend that's been happening over the past 30 years.
Just back to Europe for a second, President Dudley. From everything you know now, can you talk about what is the exposure of U.S. banks to European banks? I know you're making preparations for that.
Well, I think the good news is the U.S. banks are, much better placed today than they were a few years ago to take any sort of significant shock. Much greater capital buffers, much greater liquidity buffers. We put the banks through the large banks through a very tough stress test in the CCAR process, which was really the kind of economic environment that you might get if Europe went very, very badly. And the banks, I think, generally came through those tests in good shape. So I think we're in much better condition than we were in the past. The other thing that I think we can say on the positive side is that the bank exposure to the peripheral countries that receive most of the attention is actually very modest. Now that doesn't mean that the U.S. is completely insulated from what happens in Europe, no matter what that is. One can certainly imagine worst case outcome where you're going down a very bad path, where financial markets disruptions become severe enough so that it's not just about exposure to the peripheral countries; it's about counterparties pulling back, in terms of their willingness to do business with one another, and then having that kind of locking up of financial markets and the consequences of that in terms of economic activity, and that'd be something that would clearly affect U.S. financial institutions, clearly affect U.S. financial markets, and clearly affect the U.S. economy. And so that's the outcome that we very much would like to avoid, of course.
Stan Alcorn from WNYC, Behind the Pillar. I was wondering if you could just expand a little bit on the job losses among lower middle skill workers in the region, where you see that trend going, and if you drill down within that category, if there are any types of jobs that are going against trend.
So I think to point out what is the trend, that around New York City, this loss of administrative support jobs that's happened over the past few decades has been significant, and it's affected the region more adversely because there was a higher share, in part because there was a higher share of people working in those occupations to begin with over the past few decades. So there, even parts of the manufacturing sector have been more adversely affected, in part not just because of these trends of technology and globalization, but because there's been slower economic growth in general in the Northeast and the shift of manufacturing sort of out of the Northeast and growing more broadly in the South and in the west part of the country. What was the second part of your question?
Well, then I guess, and then are there, so you mentioned what's happening to those jobs and jobs in manufacturing. Are there lower middle skill jobs that where the story is different?
Not really. I mean, the bulk of those jobs tend to be in those two categories. I mean, there's some of those jobs tend to be in retail and in transportation, but those are a smaller share of activities, especially in the downstate area. Retail has actually done reasonably well, but it's not actually seen much growth in terms of employment in that occupation.
I think part of your question also was what did the future trends foresee, and manufacturing, one of the forces driving manufacturing jobs, these low-end manufacturing jobs, is the availability of low-cost labor overseas. One important factor, of course, going forward is just how much lower that wage is overseas relative to here. There's been some recent increases in manufacturing actually in our region, and in part because wages actually overseas in some places have started to go up. So there could be some modest reversal if labor costs also increase overseas as well. And we've seen that here in the region, that manufacturing's been actually an area of strength in the last year or so.
Some of the manufacturing companies we have visited over the last year have introduced lean manufacturing, where they've really reconfigured how they actually do their produce their output, and very, very substantial productivity gains as a consequence of that reformulation in terms of how they produce. So we have firms here that produce, for globally. So there's definitely possible for a firm here to be globally competitive.
I just add one thing. If you're familiar with our Empire State Manufacturing Survey that we do monthly, a few months ago, maybe 2 months ago, we had some supplementary questions. We asked if respondents were having trouble finding workers with particular skills, and what we found is even in the manufacturing industry, where we all think, it's an industry that's been going down, there's more unemployed workers, companies probably don't have any trouble finding people, yet they were in fact expressing that they were having difficulty finding people with particularly things like advanced computer skills. So when you're asking about things that are sort of going against the trend, even within industries that are declining or growing, you have the occupations that Rich was talking about and the skill sets, that there's less and less demand for people without, say, computer skills, and more demand. I'm picking out computer skills. This goes for a lot of different skills. That even within industries, you see these cross currents.
If I could just ask one brief follow-up. The main policy that you sketched out at the end, it seems like, are based on trying to help people move out of the lower skill categories into higher skill categories, especially since it's been very difficult and these changes are happening really rapidly. Is there a role for policy just to try to increase demand for lower skill workers, even in the short term?
Well, I think what we're trying to point out is we're doing a little bit of a simplified exercise by separating out these jobs into these categories. Within any job category, I think that the skill content and the knowledge content has been increasing. So I think what we're trying to point out is that we don't necessarily want to say that the idea here is to get everybody out of that category and into these other categories, especially because we're looking at the distribution. There's always going to be people working in different parts of this distribution. But I think we're just trying to point out that no matter where you are, no matter what type of job you're doing, this higher skill requirement is important for everyone. So even people within those jobs, it's more likely they're going to be able to keep those jobs and maintain a better standard of living if they can improve their knowledge and skill content.
Also I think what we're arguing for is taking these steps so you have better job matching, so that people, if there are job openings, that there are actually people available with the skill sets to satisfy those job openings. Because that's sort of a dead weight loss to the extent that you don't have the ability to get people into the jobs where there actually are openings.
I guess just one last thing to add on this point. I think if you look at the recommendations, you are right that there's an emphasis on skills. And the additional reason why is not only are skills important for the individual person, but when you look at the broader economy as a whole, across regions, across different countries, there's no more important predictor of economic success than the skill set of the region, and that's increasingly the case. So the reason we focus on skills is not only is there a personal individual benefit, but there's actually aggregate regional and global benefits as well from promoting skill acquisition.
Also, I think the other thing to point out is, to the extent that people have higher skills in this region, then that induces people to make their location decisions into this region, which is then increases the productive capacity of the region, the fiscal capacity of the region, which benefits the entire area.
Okay, we have a question from the web, from the Albany Times-Union. What impact, if any, has the decline of state government jobs had in the loss of middle-class jobs?
Well, I mean, first of all, that decline in state and local government jobs has been a relatively recent phenomena. It's happened during other business cycles, but this is something that's not been a sort of long-term trend like the one we're outlining here. So there may be a little bit of a connection, again, because a lot of the jobs that are lost in these middle skill categories tend to happen during recessions. Part of it may be because people who are doing more administrative type work within state and local government may be more likely to be laid off and may again have difficulty finding reemployment in the workforce over time. But again, we're trying to focus, what our numbers are really focusing on is the longer term trend rather than what's been happening just over the past few years.
The other thing I would just add to that is it's a little bit of a mixing here of categories. When you look at government as a sector, that's really an industry sector, and what we're focused on here are occupations that are across and within sectors. So government, for example, would have people who are working as a legal occupation. They'd have people working in information technology. They'd have people working in some, maybe some of the middle or lower end. So it's hard to map exactly the sector government into the specific occupations. My suspicion is that on average, people working in government have a little bit more education, and so probably less of this routine type of work that seems to be displaced by technology and globalization is really occurring in that government sector. Most of the job loss is really cyclical and due to some of the fiscal pullbacks that have been occurring as a result of the cycle, and not these forces that we've seen longer term.
Jason with two vowels, did you want to jump in, or I couldn't tell? You wanted to add something? No? Okay.
No, I agree.
It's the only way I can distinguish you guys, Jason with three vowels and Jason with two vowels. Yes.
Good to be three.
President Dudley, you mentioned that you've spoken to manufacturers who say, we can't find the people who have the skills that we need. I'm curious, do you believe that argument? How much of it is that there really is a skills mismatch and workers just don't have what employers are looking for? And how much of it is, a lot of companies have defunded their training programs, are not investing in they have very specific needs. Some people, recruiters call it the purple squirrel. They're looking for the purple squirrel, the person who fits their exact qualifications.
I don't want to mischaracterize things. It's not that people are having trouble finding workers generally. I think they're having trouble finding workers in particularly highly skilled occupations that are very high demand right now. Like one great example is information technology security. This is a very, very important subject. There's not that many people that have great expertise in it, so this is a very hard person to find to actually fill employment. So it's really, specific positions. It's not that there's a shortage of workers or more generally. And in those conversations with businesses, I didn't get a sense that this was sort of hindering their ability to carry forward their business. It was sort of more of a, an annoyance that made their life a little bit more difficult rather than something that sort of inhibited their ability to actually carry out their mission.
And I'll just mention on the survey that I had mentioned before, when manufacturers say they're having trouble finding, say, workers with advanced computer skills, you have to keep in mind that they're working on, sometimes thin profit margins, and they can't afford to just, it could be in part that they can't afford the workers with advanced computer skills, in a sense. And so one of the advantages of the upskilling people's training is it'll create more of these people. It may have a little bit, by increasing the supply of people, it may make manufacturers a little bit more able to afford workers with these high skills. That this is always a continuum, in addition to bringing down the gap, it would create more matching. So in other words, you have companies looking for workers, you have people looking for jobs, and that's part of the issue, I think.
Anybody else?
Ed Beeson with the Star Ledger. Just a couple of things. With respect to wage inequality, what do things such as minimum wage increases, laws that require that, what impact does that have on the wage inequality? And I guess with the second question would be with respect to there's a lot of headlines about student loan debts that that load is increasing dramatically. I mean, how does that impact? How does that weigh on people's decisions to really pursue more training, to go back to college for to pursue higher skilled jobs and
So as far as the minimum wage is concerned, I mean, specifically in terms of the way we looked at the information, I mean, we're looking at this widening gap in wages really across the board. It's not just between, say, people at the top end and those who are the lowest paid. We have seen some increase in wages at the for low-skilled jobs. So it's unclear to what extent the minimum wage is binding in all parts of the business cycle, and to what extent that's necessarily increasing wages for workers and decreasing inequality. So I guess we don't really have a good way, I think, of at this point of sort of saying how that is contributing to the dispersion in wages across all these occupations. So in terms of quantifying that, that's a little difficult. In terms of your second question, I think we're pointing out that access to college education is increasingly important, not just traditional college education, but any forms of education. So to the extent that people are becoming more discouraged from getting degrees, from going on to college because of things like debt or taking on expense, to the extent that that is affecting their decisions, that is going to have some detrimental impacts on people's ability to increase their skills and move up the ladder and take on jobs that that are available. Just in terms of that effect, I think to the extent that that's affecting decisions, it may be having some negative consequences.
Probably a good point just to mention, because we're talking about debt, that tomorrow we have our quarterly household debt and credit report coming out, just to flag it and shamelessly plug it for all of you here.
Has the staff done any state-by-state comparisons, for example, comparing New York to states like Texas, which, if to hear them talk, their lower tax and regulatory burdens contribute to a much more business-friendly and job-friendly environment? Any truth to that?
I don't think we've gotten in any debates with President Fisher. I think that New York City, I think as you've seen in the statistics that we presented, is actually doing quite well. And one of the things I think is what we found in New York City that's been very, very good is it's becoming less dependent on Wall Street finance as a driver for economic growth. One of the most noteworthy things is the growing role of the city as a tourist destination, especially for foreigners. It's been really quite a success story over the last few years, and that uptrend in tourism into New York City continues unabated.
Financial Times. My question is for Jason. You mentioned the ongoing cyclical layoffs, during a recession versus the...
Which Jason?
I'm sorry, Abel. I apologize. I just
Specify
realized.
the vowel number.
Versus the influx of globalization and technology, which would you say contributes more to, the current loss of jobs, and will the continuation of globalization eventually cause the cycle to dwindle?
So are you talking about the overall job growth?
In the jobs that are most affected by layoffs and by globalization.
It's really difficult to pull these two trends apart because, as I think Rich talked about, there's pretty clear evidence that, in some sense, the trend is the cycle. That when these recessions hit, it's these lower middle skilled jobs that are the ones that tend to be lost, and then they're not actually gained back when the recovery hits. So in some sense, it's sort of one and the same. It's hard to separate it out. Over time, over multiple cycles, this has continued to compound. And so in some sense, from that standpoint, the structural change that's going on is more important. But again, it's all occurring in the cycle.
Yes. Most of my listeners are in southern Connecticut and Long Island.
Could you use a mic? Could you grab a mic, please?
Most of my listeners are on Long Island and southern Connecticut. Anything specific towards those two regions in general economic conditions, but also in the labor polarization that you could talk about?
Well, in terms of just local economic conditions, remember that Long Island in particular, and to some extent parts of southern Connecticut, when you think about the whole history of the most recent cycle that started with housing, there was a much more pronounced housing cycle, boom-bust cycle that happened in that part of the region, in particular in Long Island. And so as a result, there's been a much more difficult recovery in that part of the state. And that's continued to this point. If you look at the map that Jim showed, Long Island continues to sort of be steady, flat job growth, as opposed to other parts of the state that are starting to see more robust job growth. And I think it all does trace back to just the nature of the cycle, the nature of the leverage cycle, and in particular, just being difficult to come out of that. You're seeing those effects linger longer in that part of the region. In terms of the polarization, I don't know if you've got specific numbers for Connecticut or Long Island.
We don't have due to data limitations. We weren't able to sort of drill down to local areas.
You know, one thing I would add, though, is that you have to keep in mind that when you look at the employment numbers for, say, Fairfield County and Long Island, they don't look terrible. You're seeing much more slow growth than in New York City. But one of the things that particularly areas closer into New York City have going for them is that the people who live there, a lot of them commute into the city, so they're kind of faced with a somewhat stronger job market than would be readily apparent by just looking at the local numbers. So, yeah, they're lagging a little bit in terms of self-grown employment, but they're at least benefiting by their access to New York City, and presumably as the cycle gets going, they'll get a lot of the spillover from just the general metro area.
Okay, I'm sensing that everybody is done. Or some, Bill, do you want to say something?
Well, I just want to thank everybody for coming.
Great. Thank you very much. We'll see you next time.